Welcome to our next session, where we're going to be talking about underpinning crypto asset liquidity, delivering secure and liquid asset access to crypto assets for an institutional market. Just to remind the delegates, don't forget to ask questions during this session. Our moderator, Eva, will select some at the end and be throwing that out to the panel. Don't forget also that during the speed networking break, which is at the end of panel 2, you can network in the lounge. And also there'll be another networking break at the end of the day to give you a chance to meet the other delegates. One of the downsides of us all being online is it's harder for us to connect. So don't forget to connect with other people and not just sit there listening, but make the most of the networking opportunity. And last reminder is to obviously visit our booths. All of our sponsors and partners have got booths, so they'd love to have you at a table and meet you and get to know more about you. So without further ado, I'm going to introduce our moderator, Eva Lawrence. She's the Chief Operating Officer of Arcane Crypto. Very grateful to have you here today, Eva. Thanks very much for joining us, and to all the panelists. I'm going to leave you now to introduce the rest of the group and to start the discussion.
Thank you, Helen. So I think most of us here come from a traditional finance background. We were just discussing prior to the panel that a lot of us have roots in the traditional finance sector. And what we've seen in the crypto asset exchange space is a real convergence of traditional and newer markets, especially in terms of daily traded volume. Also, there's been a growth in institutional demand for this asset class, and that's something that a lot of our panelists today have seen and are going to share their experiences of. So without further ado, why don't we hear from each of the panelists covering both exchange operators, leading liquidity providers, and they're going to share with us how this industry has matured and how what they're working on compares to the more traditional companies. So should we start with you, Henry?
Sure, yeah, thanks, Eva. Henry Durrant here. I am Head of Business Development at Reactive Markets. At Reactive Markets, we operate a market utility for OTC crypto and FX trading called Switchboard. The aim of Switchboard being really to help liquidity providers in the FX and crypto space really scale their business, connect once via our ultra low latency infrastructure, and meet, essentially hundreds of OTC clients of theirs. On the flip side, we give takers of liquidity completely free of charge access to all of their OTC liquidity providers via our single API or UI. I've been a very keen participant or attendee rather of a bunch of Coinscrum events in the past, and it's it's great to be part of the panel here, and I'm really looking forward to it.
Great, thanks, Henry. Leon, do you want to jump in next?
Yeah, certainly. First off, thank you very much for the invite. I'm really excited to be here. I used to attend a lot of the Coinscrum events when it was possible to do so. And just really excited to be a part of the panel. So my name is Leon. I'm the Global Head of Sales at Genesis. So we are a crypto prime broker located in New York City. We have offices as well in Singapore and London. We're really focused on serving institutional clients with 3 verticals. 1, we focus on spot and derivatives trading. 2, we focus on lending and borrowing. And 3, we offer a custodial service for those clients. Really excited to speak with everyone on the panel.
Great, thank you. Rupertus, over to you.
Thank you, Eva. Thanks for having me on the panel. My name is Rupertus, and I'm the CEO of Crypto Broker AG, who is a subsidiary from Crypto Finance Group in Zurich. We are probably, if I'm not mistaken, the only FINMA-regulated securities broker in Switzerland. We cover B2B customer for crypto spot, and currently enhancing our product mix into staking, borrowing, lending, and other prime broker services. We are around about 60 people. We do our own storage and custody solution as well, enabling our institutional clients to trade, settle, execute, pay, and store with us. Good to have me. Thank you.
Thanks. And Duncan?
Yeah, thank you. Thank you, Eva. Nice to be here. Also a big fan of Coinscrum, avid reader, so great to be on a panel. So I'm Duncan Trenholme, co-head of digital assets at ICAP. ICAP is the world's biggest inter-dealer broker, which means we're a market intermediary. We run electronic trading platforms. We have voice brokers. We do a lot of hybrid liquidity across equities, bonds, pretty much every asset class that's out there. We have been in crypto since it goes back to 2017, the origins of our experimenting in this asset class. In 2019, we started broking the CME Bitcoin futures and then added the options products on. We have added to that, we're looking at total return swaps, over-the-counter derivatives, and we really recently announced that toward this end of this year, we're expecting to launch an electronic trading platform for crypto that's slightly different to the model that's out there currently. It's going to have clearing and settlement services at Fidelity, Standard Chartered, helping to bring on our customers, which are the banks, buy-side, commodity trading firms, into this asset class, and hopefully helping it to scale.
Great, thank you. So if we kind of take a few questions with each of you now. So we've mentioned that there's been increased institutional demand in the digital asset space over recent years. And as a result, each of your firms will have had to rapidly evolve to meet the expectations of these new users coming into the space, also satisfying potential existing users of traditional asset classes. And then on top of that, you've got regulatory requirements in both spaces. So if we start, Rupertus, with you, in terms of what you and your firm have been looking at. You mentioned you're regulated and licensed by Swiss FINMA, and you've been providing brokerage services back until 2007. Originally, as I understand it, on a more retail focus, but now solely professional client base. And I think that's kind of representative of how the industry's changed, right? First, it started out as a retail-focused industry, and now it's definitely evolved. So what are the challenges you and your team have witnessed over time with accessing liquidity across exchanges and OTC brokers?
Yep. You're absolutely right. I couldn't agree more. Crypto space is another example where, interesting enough, the retail space had led the train into the market. A lot of these retail brokers emerged out of the nothing, got tremendous funding, superb technology, and enjoyed a beautiful bull run on the underlying and an increased volume on the customer base. The institutional clients are a bit more picky, I would say. It's still very much for us, and we, as I said, we are one of the few FINMA-regulated entities. For many institutional investors, especially banks, crypto is still very much a difficult animal to digest. They do not really want to get involved. On the other side, they must get involved. Clients are asking for access. They don't want to grant access. They don't want to deal with wallets and keys. On the other side, there are structured products available where you can get exposure access, and we simply book the same thing as security. I think apart from the fact that a lot of, I would say, internal hurdles within financial institutions can be passed by simply educating and demonstrating how safe and secure and clean our business is. And we have extraordinary measurements how to find out if a coin is tainted in where we receive in our wallets or not. We spend a great deal in making sure that our business is crystal clear, and we are only dealing with institutional, mostly regulated entities, so you trust each other. First of all, I think it's all about trust. Institutions need to gain trust that what we do is a proper business. Secondly, if it looks very fancy, digital, and hypey to trade Bitcoin or Ether, the back end of the transaction is kind of where we were in the FX market in the early 80s. So there is still a lot of different systems, very little automation, very little netting. And first of all, you need to connect to the core banking system of the bank. Now, if you're a new challenger and you want to create a new financial powerhouse, you might start in the new world. But dealing with the big banks, high street banks in London, Wall Street banks in New York, Frankfurt home-based banks, they sit on 30, 40-year-old banking infrastructure services. And to bridge those modern, fast, and exciting businesses with the legacy technology in the banks, that's part of the main challenge we have. Just to give you an example, onboarding one of the biggest retail banks in Europe took us almost a year just to get it done on technical, regulatory, and legal stuff.
And how does that relate to their expectations of the market in terms of depth of market, access to liquidity, depth of liquidity? So you mentioned that there are issues in terms of kind of the structural and technology side of things, but what about their actual expectations of the digital asset space compared to the traditional finance space?
It's tremendously growing. I mean, if I sounded too negative in my previous answer, that shouldn't have been the result. I mean, there is a lot of interest, and there's a strong momentum in the market. And I could show you slides which we present to market participants and potential clients right now, where sentences, messages, prints in the newspaper from banking CEOs from 24 months ago, when they said this is all horrible and it's all going to go wrong and this is all money laundering and terrorist financing, it's all crap. Suddenly they open up trading desks, they create infrastructure, they allow asset aggregation into funds. So the world is changing, and as usually in financial markets, it doesn't change overnight. People, as I said, people need to gain trust and faith into the systems and into the environment, but the demand is definitely there. We have clients using Swiss private banking as their wealth management banker, willing to deal with us. They were rejected from their wealth managers because they do not want to bank a client who acts in crypto. It's crazy, but this is how it is. So the customer says, now do I have to find myself a new high net worth individual banker in order to execute in cryptos? And the guy says, yes, you should. It's amazing. So, and this continues. Some of the big wealth managers will disappear from the planet because the customers are not anymore sitting there and stand still and simply accept a no as an answer. When the rest of the world is enjoying beautiful ideas of investments and returns and whatever, it's coming and the demand is there. The interest is there. It's changing slow, but it's changing in a dramatic way.
And what kind of ticket size are you kind of seeing on your marketplace at the moment? Like what is now considered a large ticket size in the crypto space, say compared to a couple of years ago?
It's you just don't mix high frequency trading and what we do to our customers. If a Tower Research, a Galaxy Digital, a B2C2, a Flow Trader, if they pump $1 billion into a market a day, arbitraging around the globe with various machines and bots and small ticket sizes, but creating tremendous amounts of volumes, that's their business. Our business is a private banker connects via API or WebSocket to our trading engine. He's asking for a price. He can trade directly on our house price. If the order exceeds our bid and offer spread size, then he has to ask for an RFQ. A big order, it depends. Bitcoin dollar is liquid. Polkadot in Zing dollar is not liquid. So we have to make a differentiation what we trade and what we offer. But I would say in Bitcoin, in US dollar, a large order is somewhere between 20, 30 million. That's where it starts getting quite chunky because then we have to split the order, hedging it, because we won't have the balance sheet to execute a $30 million order on our balance sheet. And in smaller coins, in altcoins, a large order might even start at 5 to 10 million.
Okay, great. Let's move on to Genesis and Leon, to you. So Genesis were one of the earliest firms to establish an OTC desk for professional participants. And you and your team provide trading, lending, and custody solutions. And as I understand it, both spot and derivatives liquidity. Can you give us some color on where the real liquidity resides? Is it on exchanges or is it via OTC desks?
Yeah, sure. Really happy to answer. So I think the first point is that for a firm like Genesis, it's important for us to distinguish what we actually mean by liquidity. So When the market is calm and going up and people are making money, liquidity seems to be everywhere. Liquidity only really becomes an issue when you have events like sort of March, sort of the second week of March during COVID, May 13th, I think it was, or May 19th rather, this year. When the market is in a moment of extreme stress, I think that's the moment that the question of liquidity really comes to the fore. And what we've certainly noticed at Genesis is that there have been some structural changes that have taken place, which have meant that the access to liquidity in those moments is potentially worse than it would otherwise be. For example, we've seen a proliferation of centralized lending companies, a proliferation of DeFi lending organizations. We've seen retail access to derivative markets, especially in Asia. And so when the proverbial, what hits the fan, these folks are all at the same moment in time for sellers, and liquidity disappears. So for a firm like Genesis, what we try and do is we try and ensure that regardless of what the market liquidity or market conditions at the time are, we're able to supply that liquidity. And we do that in a number of ways. One way we do that is a connectivity ourselves. So back to your original question, dealing with a firm like us, you're actually also connected with multiple exchanges through us. And it might be the case that you're connected to exchanges that you can't otherwise access, right? You might be in the US, unable to access Deribit, or you might be in Europe, unable to access the CME. So this is where the added edge of dealing with a firm like Genesis really comes to the fore. And then secondly, we have our own internal liquidity, a sort of effective dark pool. So we might be given a bunch of risk in Ethereum, but then someone wants to lift us in Bitcoin, and then that's on us to ensure that we manage that properly. So
would you even say events like those that occurred in March are actually good for the market because it kind of stress tests the liquidity that's out there, and kind of gives the opportunity for kind of Genesis to demonstrate exactly what it can offer, but to demonstrate to the market, what areas there are potential issues with liquidity and breadth and depth of market.
Yeah, that's a really good point. Like, it's certainly good after the fact. Like during the event, it's never good, and it never actually is. Like, I always try to think in the long term when these things are actually occurring, but I suddenly become quite myopic, like I think most people do. But thinking in a slightly longer perspective, yes, it is good, because what we can then do is when we're speaking with major banks, we can say, look, this is how we performed at the time. We've had no liquidations, we've had no defaults, we've had no capital losses on the largest institutional lending book in the space during multiple times of extreme market moves. The space is growing up, and a firm like Genesis is an example of why that's the case.
Yeah, and then in terms of the lending market, I mean, you touched on it already, and kind of had the impact that has on liquidity. And there's obviously massive growth with, large firms like yourselves offering lending, but also smaller firms offering it to all participants, really. I know that's not necessarily your model, but how do you think that has an impact on liquidity in the market? Obviously, it has a negative impact if we come to a particular market event, as we just discussed. But in general, what do you think this kind of increased lending has done for the market?
Yeah, I mean, it's a good question. There's sort of a couple answers here, but like number one, it's really supplying liquidity and working capital to market makers, enabling them to settle more quickly and increasing the turnover in the system. And that obviously helps liquidity. And number two, for a select number of clients for whom we're comfortable with credit risk, we're able to extend their credit such that they can execute either with delay settlements, or they can sort of leverage themselves into longs and shorts without having the capital immediately available to do so. So that's important in an age where they may be expecting some assets from an exchange, they don't have the assets quite available. That's where Genesis can come in and sort of help that capital efficiency. So those are the principal two areas where sort of lending add to that liquidity.
Great, thank you. Henry, if we jump to you now, So Reactive has its foundations in the traditional FX market, and you've been involved in the crypto industry for the last couple of years, but in that time, I'm sure you've seen a lot of change to the industry already. How much does the infrastructure in crypto trading compare to the traditional markets? Could you kind of give us some examples of where you see similarities and where you see differences?
Yeah, absolutely. Thanks, Eva. So, I mean, I think the short answer to your question is it's come on leaps and bounds in the last couple of years and continues to do so. So, I think if we kind of focus on the trading protocol space specifically, we've seen a big shift from institutional participants starting to move away from REST, WebSocket, these slower code protocols to more robust, faster, institutional type API connectivity like Fix, for example. So I think it's the crypto market was very much born out of the retail exchanges, as Rupertus alluded to, and I think a lot of these were obviously built without perhaps not necessarily future proofing themselves on day one for the mass adoption of institutional clients, these larger ticket sizes, these HFT liquidity providers. And a lot of the protocols and core technology is just not built for that purpose. So you've got a lot of guys working on that. And actually we found that most, if not all of our liquidity providers have put a lot of work into their electronic market making, not only on the price discovery side, but also pushing those quotes out to their clients as quickly as possible. So I think that kind of ties into perhaps my next point, which is really the growing focus on addressing the challenge of latency in the market. So, in traditional markets where the vast majority of electronic trading happens in these dedicated colo centers in Equinix, LD4, MY4, TY3, etc. Again, crypto, because of the way that the exchanges have been set up, runs almost exclusively in the cloud still. And the cloud is brilliant for many purposes. We use the cloud pretty extensively, but when you've got exchanges and liquidity providers having their pricing servers distributed all across the globe, you have an inevitable challenge of addressing geographical latency, which simply can't be overcome. So I think the next phase of this evolution of technology, specifically in the electronic trading space, that we're likely to see, and actually we've already started seeing it, is this move from liquidity providers to start hosting their pricing and trading infrastructure in dedicated data centers. I think this is the only way that you can combat these latency challenges, and we're already seeing actually some of our liquidity providers are connecting to us in these dedicated centers. So from our perspective, it's completely client driven. We operate a hybrid cloud colo model. All of our tech can run either in the cloud or in dedicated hardware. But I think we're likely to see more and more of these participants moving into dedicated colo.
And in terms of your clients reaching out to you and saying, I'm interested in getting involved in the crypto markets and transitioning across from FX, or in addition to my FX business, what themes are they raising to you as concerns or as areas they're looking to find out more as they understand kind of how OTC markets in crypto work in comparison to, say, the traditional finance space?
Yeah, so I actually think there's a really interesting shift in the dynamic of kind of OTC market structure in crypto right now. So I think we're starting to see a real distinction between in the interdealer market. So the space where the likes of Duncan operates, where you're giving dealers in the market a robust, liquid central limit order book or exchange to go and exchange risk with each other, perform price discovery, all the facets that you need to build a solid price distribution business. That is becoming more and more separated to the space we operate in, which is very much the dealer to client space. And actually, for the market to operate as it needs to, those two things need to happen side by side.
Right.
So these liquidity providers that we work with need these central limit order book venues for price discovery, for risk exchange, and they actually can't build a price and distribute a price without those. So we're starting to see that obviously happens very extensively on the retail exchanges already, but I think the work that the likes of Duncan and others are doing to kind of really future-proof that for when these large banks get involved and so on is absolutely key. Sorry.
And that's the kind of the perfect segue over to you, Duncan. And kind of obviously TP ICAP has been very well known in the traditional finance space for a very long time. And there must have been a lot that you and your team have considered in deciding when to get involved in the crypto space. You have the understanding of what's required in terms of market development, infrastructure, before you thought that you and your team would be ready to launch. So what are the factors that you considered prior to launching the digital asset business?
Yeah, good question. And it's almost like we practiced that before, Henry, wasn't it? What a segue. Yeah, so we've taken a sort of careful and methodical approach to this asset class. And I think the reason we started with futures and options on regulated exchanges like the CME is what we're seeing from a lot of our clients is that's their starting point too. It's TradFi is traditional infrastructure referencing a crypto asset, something that gets you exposed to the market from a price exposure, but isn't much of a lift from having to understand a digital wallet, having to interact with blockchain based assets. Now, for us, in terms of timing, I think the key thing, there were two things really that we heard from clients consistently, and around market timing, why now? I think the first one was qualified custodians. That was a big topic of discussion a couple of years ago, and it's certainly by no means, we haven't reached the final state yet, but the first thing that a wholesale, a truly institutional customer asks first is like, how do I store these assets? How do I, that needs to be segregated. It's not something we can do in-house. We have to have a qualified external custodian for regulatory reasons, and it needs to be often either they need a great track record, the right insurance, or what we see a lot of the time is just familiarity is key, right? Traditional brands that they can get through their own internal approval processes, and that their kind of compliance and risk teams can kind of sign off. So that was the first thing, and then the second thing was just how do you then trade without having to pre-fund execution venues? Because this is when you put this market structure in front of traditional financial counterparts, they struggle with the idea of I've picked my custodian, that's the place where I trust to store my assets. I have to withdraw my assets from custody and deposit them on an exchange and take credit risk against the exchange, and often those exchanges are unfamiliar brands that we're not familiar with. Either that, or you deal with a number of the very good OTC market makers or broker dealers that are out there, in which case it's very much a kind of you've got to take a credit decision against that counterparty yourself, right? So what TP ICAP has done previously in markets is when these institutions start to come together, we think about the questions like, okay, so if you're custodying your assets in one place and someone else is custodying somewhere else, how does that the trade life cycle work, right? You want to pre-match, you potentially want to pre-match with some form of credit information, or at least know that there's collateral there. You then want to be able to have price discovery across a wide range of different dealers and get best price. What happens post trade? Is their name given up? Do you have manage your counterparty risk? Are you dealing against a central institution? And then it's okay, what we're really excited about is blockchain-based assets, and we think crypto is just the first asset class on this technology. I mean, this is something that I think Rupertus was talking about in terms of most systems are 40 years old, right, in traditional finance. This, we had 15, 20 years ago, the electronification of markets, but really that was very much around price discovery, liquidity. We're talking about having fixed APIs across crypto assets now. That space has matured massively in the last 10 years. What hasn't is post-trade, right? The actual financial product itself is still on, every asset class is on a different system. Most of these systems don't talk to each other. You'd laugh, but there's still like manual reconciliation going on where people are like comparing, well, I see 1,042, I see 1,053. Oh, we have a settlement break, right? The crypto assets are bringing this kind of new open source layer that everybody can plug into, but that settlement infrastructure is kind of yet to be written. You know, you have custodians, but they don't talk to each other. And there's innovation there. But what we've kind of looked at is, okay, how can we help that? How can we provide price discovery across, a global network, which TP ICAP has? And then how does that, how post-trade, how does that settle? What's the most efficient way for it to do it? And how do we manage credit risk, operational risk in that area?
And as your clients start looking at this, would you say that you're seeing demand for this service now, or would you say that the clients are at a stage where they're just exploring it? Is it kind of exploration, or is it demand driven at the moment?
Yeah, really good question. I would say it's a real mix. I think it depends on the profile of the institution, and really the biggest thing is, what's your risk appetite? It's probably no surprise that market makers and proprietary dealing firms were kind of one of the first after this move from retail upwards, because they have a bigger risk appetite, right? And then the majority of financial institutions. The opposite end of that is, large investment banks, right? And I think, again, what Rupertus said previously about the onboarding process for that, it is in the order of years, right? It goes from the idea, and often we're seeing this like coming out of the FX area, or it's in the equities area somewhere. Potentially there's a global working group. You need to get, first off, like sort of political sponsorship. The bank or the institution needs to have the motivation to do it, and sometimes that's coming from assets being onboarded or offboarded off platform because they can't provide crypto assets. But then it's like coordinating that together, and probably from idea, you've got to do due diligence of the market. There's a whole host of kind of requests for services going out there at the moment to every crypto institution. How does your service work? And these questionnaires are like 300, 400 questions long about, what is your operational resilience, like what is your technical resilience, and these things have to get signed off, and then it has to go to various different boards, and that just takes a while, right? So I would say it's a mix. Some can move quickly, some are really keen to get involved, and there's volatility there, there's opportunity. Some see the let's innovate in crypto and be ready for tokenization, and at the other end it's slow moving.
Yeah, and I think kind of a question for everyone, and just in terms of the market in general, it's clear that there's been significant improvements in liquidity, access to the markets across the board, especially for institutional investors. But what is the kind of biggest challenge that you personally see at the moment to secure deep liquidity in the crypto markets? So I don't know if someone wants to jump in first on that one.
I can have a go first, shall I? So I think actually the way the way you phrased the question, Eva, it's both. That actually is the challenge. It's this fragmentation we now have, where you've got countless exchanges, countless liquidity providers, and actually in many cases you've got the same liquidity providers sending the same price into multiple exchanges. So this creates this mirage of liquidity. It's very difficult to manage. It's a big challenge for smart order routers to overcome, and actually I think that's why we've seen, and actually in many kind of cases, why we've pivoted our business in the last year towards the OTC space, because what we're finding with these institutions we're dealing with is in many cases, it's actually far, from a cost of execution perspective, it's far better to target a direct OTC dealer in a full amount and receive a risk transfer price that you have, very high probability of fill, as opposed to going and spraying your order across, potentially hundreds of venues and obviously dealing with the market impact and the slippage associated with that. So I think that's a really interesting space to watch. And actually, I think that's where, execution analytics, a lot more of this detailed TCA that we're familiar with in equities and FX is starting to take shape. And I think, for the record, I think that should be something that service providers like ourselves and others, provide to optimize the client and liquidity provider relationship as part of the service.
Maybe I can add to something that I think you're muted there, Eva.
Yeah. I was going to say, do you want to carry on? Go ahead, Leon.
No, I was just going to say I really like the point that Henry just made. Like especially when so if you're a major institutional client and you're looking to transact in very large volume, there's a number of concerns you might have, one of which might be privacy, one of which might be slippage, another of which may simply be, how do I ensure that that we had the correct reporting set up here, and that we're facing a firm that in the correct regulatory jurisdiction. And so, like, when we think about access to liquidity, it's actually multifaceted. You have that regulatory piece, you have that relationships side, right? So do you actually know someone at who is a founding member of a particular protocol? Could you get extra liquidity that way? There's a technology side that they've mentioned, that there's credit as well. There's banking, right? Do we even have the local relationships in the banking side? And Rupertus, I'm sure, and their firm have done very, well on that, especially in that local sort of Swiss market. So there are all these elements that serve to make make liquidity more fragmented. And the question then becomes, all right, well, what type of institution can you work with in order to alleviate those concerns? And Henry mentioned some of the OTC folks. I think that's where the OTC participants have some edge, I think.
Eva, I'll just add, ironically, I think one of the biggest issues in scaling crypto liquidity is the fiat side of things. Like, most of the industry is on, a handful of different firms that have appetite for that, and their credit profile is very good, and they're grown, etc. But you talk about getting real wholesale counterparts into this market, and that credit appetite will not scale, and you'll hit limitations very quickly. And it's kind of ironic to think of it that way, but that's one of the biggest problems, I think. And the more quicker that we can end up with, some of the traditional banking counterparts offering services to crypto-based institutions, I think that will really help.
And that actually leads to kind of a question that was raised by the audience that we can just quickly touch on before we wrap up, is in terms of kind of the fiat on-ramps, do stablecoins have a role in sourcing liquidity? And if so, are you concerned with regulation and how this might be impacted?
If I may start on that one, I think you should not underestimate the importance of stable coins, and it doesn't matter if it's USDT or USDC. Many of the exchanges still do not have fiat on-ramp, so the only ability to move on is in stable coins. The downside, or the flip side of the coin, is in some jurisdictions, for example, in Switzerland, stable coins are considered coins, so it requires exactly the X times working capital as if we hold Bitcoin, Ether, or Solana in our portfolio. So that's difficult for us. On the one side, we are not a bank, so whatever a customer sends us fiat, we have to execute the order. If for any given reason the order is not really fulfilled, or the price has moved away, or something has happened, we are theoretically enforced to send back the fiat, because if we would, even with agreement of the customer, if we would park the money in a stable coin, we would have to deposit a working capital with our bank. So it's core. And I can only hope that some of the initiatives of various central banks are fruitful, and there will be more stable coins and real stable coins, if actually central bank money being tokenized, because it's going to help the entire economy. And one final comment on your previous question, Eva. I mean, if the Germans have just changed the law that they allow a certain percentage in alternative investment funds to be invested into cryptos, that's a 400 billion wallet. I mean, it is almost the size of the current market, what we are talking about. So if this institutional adaptation continues, I think those currencies will not drop far from where they are traded now. That's for sure, because there is a lot of money and a lot of wealth sitting untouched, untapped, because for the reasons we all described in terms of onboarding, trading, settlement, post-trade systems, reporting, risk reporting, is still in the killer shoes, I would say. And I always compare it with a little bit with what we've all experienced in the structural products market 20 years ago. Retailers started to create a mass adoption, and then it was moved over into the institutional space, and we see exactly the same thing happening now. And I can only enjoy the next couple of years to come, because this is just the beginning of a very long journey.
Exactly. I mean, I think we're going to continue to see that convergence between the traditional markets. The growth of new players will only be helpful, and the same goes with kind of bringing together the different liquidity providers to offer kind of more less fragmented liquidity. I think that's all we have time for now, but thank you very much to everyone. Really interesting to hear your views.
Thank you.
Thanks, Eva.
Thank you.
Thanks very much, Eva. Thanks, guys.
Eva, thanks so much for fantastic moderation, and thank you very much to all the speakers as well. It's really excellent panel discussion. I think we only had one question, but we had a lot of great debate between the panelists themselves, and I encourage anyone listening to throw out more questions in the future. Don't be shy, because it's all part of the conference atmosphere. We want to get people discussing and chatting. So for now, I'll just close by thanking this panel. Hope you'll join us for our next session on market infrastructure, which is starting in a couple of minutes.
Thanks, Helen.